If you are over the age of 65 and you just filed your taxes the exact same way you always have, you almost certainly handed the Internal Revenue Service thousands of dollars you were legally entitled to keep. Right now, there are 5 specific tax breaks designed exclusively for retirees and seniors. Yet according to tax professionals, the vast majority of older Americans have never claimed a single one of them. We are talking about legally bypassing taxes on your mandatory retirement withdrawals, reclaiming the money you spend on Medicare premiums, and taking advantage of a brand new $6,000 deduction that just went into effect for the 2026 tax year. But here is the hard truth. The IRS is never going to tap you on the shoulder and politely offer these savings to you. If you do not know exactly what forms to file and what boxes to check, that money is gone forever. This is arguably one of the most challenging financial periods in modern history to be navigating retirement. You are dealing with the lingering effects of inflation squeezing your fixed income, property taxes marching steadily upward, and the quiet, relentless rise of healthcare costs. In this environment, every single dollar you save in federal income taxes is a dollar that stays in your checking account to protect your independence and your peace of mind. Today, we are going to walk through these 5 incredibly powerful tax provisions, step by step, in plain English, so you can immediately stop overpaying the government. I am going to share the second most powerful strategy right out of the gate, work our way through some hidden gems that even sophisticated tax software frequently overlooks, and save the absolute biggest, most game-changing new tax break for the very end, because it completely rewrites the rules of retirement taxation for 2026. Grab a pen and paper because this information could change the trajectory of your financial life. Let us start with what is widely considered the second most powerful, yet severely underutilized, tax strategy available to retirees today. It revolves around a deeply frustrating problem that almost every saver eventually faces: required minimum distributions, or RMDs. The setup is familiar to anyone who has spent decades responsibly putting money into a traditional IRA or a 401k. For years, the government allowed that money to grow tax-deferred, patting you on the back for your financial prudence. But the moment you reach age 73, the rules of the game abruptly change. The IRS steps in and mandates that you begin withdrawing a specific percentage of that money every single year, whether you actually need the cash to live on or not. This forced withdrawal creates a massive cascade of financial tension. Suddenly, this phantom income pushes you into a significantly higher tax bracket. Worse, it increases your adjusted gross income to the point where up to 85% of your Social Security benefits suddenly become taxable. And if that were not enough, it can trigger what is known as an IRMAA surcharge, heavily penalizing you by drastically increasing your Medicare Part B and Part D premiums. You are effectively being punished for having saved money. But there is a brilliant payoff to this problem, and it is called the Qualified Charitable Distribution, or QCD. If you are age 70 and a half or older, the IRS allows you to transfer funds directly from your traditional IRA to a qualified charity, and this transfer completely bypasses your taxable income. You can transfer up to $105,000 per year using this method. The absolute magic of the QCD is that it counts toward your required minimum distribution for the year, but because the money goes straight from the IRA custodian to the charity, it never shows up on your tax return as adjusted gross income. You do not have to itemize your deductions to get this benefit. You take the standard deduction, enjoy that massive write-off, and still get the full tax benefit of your charitable giving. By keeping that RMD money off your tax return, you actively suppress your adjusted gross income. That, in turn, protects your Social Security benefits from taxation and shields you from those dreaded Medicare premium surcharges. Yet, despite how incredibly powerful this is, a shockingly low number of retirees use it because they simply withdraw the money first, deposit it into their checking account, and then write a check to their church or favorite charity. The moment the money touches your checking account, the taxable event has occurred and the QCD strategy is ruined. You must request the direct transfer from your financial institution. Moving on to our next highly overlooked provision, we need to talk about the medical expense deduction. Now, you might be thinking that you already know about this and that you cannot use it because you do not itemize your deductions. It is true that ever since the tax code was overhauled a few years ago, the standard deduction was raised so high that nearly 90% of taxpayers stopped itemizing. The tension here is that millions of seniors face crippling out-of-pocket medical costs every year, from dental work to prescription drugs, and they assume they get zero tax benefit for it because their total itemized deductions simply do not cross the high threshold required to beat the standard deduction. They just accept the loss and move on. But the payoff lies in a specialized strategy known as expense bunching, combined with a deep understanding of exactly what the IRS actually classifies as a deductible medical expense. First, the law states that you can deduct qualified, unreimbursed medical expenses that exceed 7.5% of your adjusted gross income. For a retiree living on a modest, mostly tax-free income, that threshold is actually much lower than you might realize. Second, most people have a dangerously narrow view of what counts as a medical expense. Did you know that your Medicare Part B and Part D premiums, which are automatically deducted from your Social Security check, count as deductible medical expenses? What about the premiums you pay for long-term care insurance, or the massive out-of-pocket costs for a hearing aid, new eyeglasses, or necessary dental implants? Furthermore, if you had to make modifications to your home to age in place, like installing a ramp, widening doorways for a wheelchair, or putting grab bars in the bathroom, those capital expenses are often fully deductible as medical expenses. Even the mileage you drive to and from your doctor's appointments counts. To actually claim this, savvy retirees use the bunching strategy. Instead of having a moderate amount of medical expenses every year and never crossing the threshold, they intentionally schedule their elective procedures, heavy dental work, and bulk prescription purchases all in one single calendar year. By stacking all of these costs, plus their Medicare premiums and long-term care costs, into a single 12-month window, they forcefully blast past the standard deduction threshold and claim a massive write-off on Schedule A of their tax return. Then, the following year, they simply revert back to taking the standard deduction. This strategic timing is entirely legal, heavily encouraged by tax planners, and yet completely ignored by the average taxpayer who just pays their medical bills as they come without looking at the calendar. Are you starting to see how much money is slipping through the cracks? We are only on the second point. If you find yourself nodding along and realizing you might have missed out on these, do not feel bad. The tax code is over 70,000 pages long, and it is designed to be confusing. Let us reset for a moment, take a breath, and look at a provision that is so rare, even popular consumer tax software routinely skips over it unless you manually force it to look. This brings us to our third overlooked strategy: the credit for the elderly or the disabled. The setup here targets a very specific demographic of retirees who are living on fixed, lower incomes. As we age, our earning potential naturally drops, and for those who rely heavily on modest pensions, small annuities, or minimal investment income alongside their Social Security, the tax burden can feel suffocating. A tax deduction simply lowers your taxable income, which is nice, but a tax credit is vastly superior. A tax credit is a dollar-for-dollar reduction of your actual tax bill. If you owe the IRS $1,000 and you get a $1,000 tax credit, you owe exactly zero. The tension surrounding the credit for the elderly or the disabled is its intimidating complexity. To claim it, you must fill out a famously confusing document called Schedule R. The IRS has established strict, rigid income limits to qualify. Generally, you must be 65 or older by the end of the tax year, but your adjusted gross income must be relatively low. For instance, typically under $17,500 for a single filer, or under $25,000 for a married couple filing jointly where both spouses are over 65. Furthermore, the non-taxable part of your Social Security or pension cannot exceed certain limits, usually around $5,000 for singles or $7,500 for couples. Because these thresholds are so tight and the formula on Schedule R is so convoluted, most people assume they do not qualify, or their tax software simply bypasses it to save time. But the payoff for those who do qualify is a non-refundable tax credit, ranging from $3,750 up to $7,500, depending on your filing status and income. This credit can literally wipe out your entire federal tax liability in a single stroke. This is incredibly vital for widows, widowers, or single retirees who are barely scraping by and suddenly find themselves owing a few $100s to the IRS because of a small pension payout. If your income is on the lower side, you must explicitly demand that your accountant run the numbers for Schedule R, or you must manually navigate to that section in your tax software. Do not leave a dollar-for-dollar tax credit sitting on the table just because the math looks a little intimidating at first glance. Now let us move to our fourth major tax break, which addresses a very modern retirement reality. It used to be that couples retired at the exact same time, got their gold watches, and rode off into the sunset. Today, it is incredibly common for one spouse to retire at age 65 or older, while the younger spouse continues to work full-time or run a small business. The setup here is that the retired spouse often stops contributing to their retirement accounts because they no longer have earned income from an employer. The IRS rules state that you cannot contribute to an IRA unless you have taxable compensation, like wages or salary. So the retired spouse feels tension. Their retirement savings stall, they lose out on tax deductions, and they watch inflation slowly eat away at their purchasing power, feeling powerless to keep building their nest egg because they are no longer punching a clock. The payoff is an incredibly potent provision known as the spousal IRA. The IRS allows the working spouse to use their own earned income to fund a traditional or Roth IRA in the name of the non-working retired spouse. As long as the working spouse earns enough to cover the contributions for both of them, and you file a joint tax return, the retired spouse can continue piling money into a tax-advantaged account. But it gets even better. Because the retired spouse is over the age of 50, they qualify for what the IRS calls catch-up contributions. For the 2026 tax year, the base limit for IRA contributions has been increased, but with the catch-up provision, an older individual can contribute up to $8,600 into their IRA. This means that a working spouse can fully fund their own IRA and then take another $8,600 of their hard-earned money and drop it into the retired spouse's traditional IRA. That combined action creates a massive immediate tax deduction on your current year's taxes, drastically lowering your joint adjusted gross income. It allows the retired spouse to keep growing their money in a tax-sheltered environment, completely ignoring the fact that they have not worked a single day that year. It is one of the very few times the IRS allows you to magically transfer the tax benefits of your labor to your partner, and thousands of couples miss out on this simply because they assume retirement means the end of retirement account contributions. We are about to move into the final, absolute most crucial tax break on this list. Before we do, I want to plant a flag right here. If you have been listening so far and thinking that your current tax strategy is basically just crossing your fingers and hoping for the best, you are not alone. Everything we have discussed so far requires a little bit of proactive planning. But this next provision, the grand finale of our list, is something so fundamentally massive, so recently enacted, and so overwhelmingly beneficial that it will literally rewrite the tax returns of nearly every single American over the age of 65 this year. You do not have to be wealthy to use it. You do not have to itemize to use it. And you do not need a complicated legal strategy. You just have to know it exists. For years, seniors have struggled with the basic standard deduction. Yes, it was large, but it never quite felt like enough to shield their Social Security and modest retirement withdrawals from the IRS. The tension has been building for decades. Retirees are living on fixed incomes while the cost of groceries, utilities, and property taxes skyrocket. The government was heavily taxing the very benefits seniors relied on to survive. Up to 85% of Social Security can become taxable if your income crosses a relatively low threshold, creating a brutal stealth tax that punishes you for having saved even a modest amount in a 401k. The extraordinary payoff has finally arrived in the 2026 tax season, courtesy of a massive piece of legislation enacted in 2025, known as the One Big Beautiful Bill, or OBBB. This legislation introduced a temporary but immensely powerful new provision, specifically called the Enhanced Deduction for Seniors. Let me break down exactly how this works because the math is staggering. First, you have the regular standard deduction, which for 2026 has been adjusted for inflation to $16,100 for a single filer and $32,200 for a married couple filing jointly. Second, because you are over the age of 65, you automatically get to stack the additional standard deduction for age on top of that. For 2026, that extra age deduction is $2,050 for a single person, or $1,650 per person for a married couple. But here is where the absolute magic of the new 2026 law comes into play. The OBBB created a brand new third layer of tax shielding, a flat $6,000 additional deduction per eligible senior. This is not a replacement for the standard deduction. It sits directly on top of it. If you are a single retiree over the age of 65, you get the $16,100 base, plus the $2,050 age bonus, plus the new $6,000 senior deduction. That means the first $24,150 of your income is completely 100% invisible to the federal government. You pay zero federal income tax on it. If you are a married couple and both of you are over 65, the numbers become truly monumental. You get the $32,200 joint base deduction. You get $3,300 for the combined age bonus. And you both get the new $6,000 senior deduction, totaling $12,000. When you add that all together, a married couple over 65 can shield an astonishing $47,500 of income from federal taxation in 2026 without having to itemize a single receipt. This is a complete paradigm shift. For the average retiree, whose income consists of Social Security and modest IRA withdrawals, this new stack deduction is large enough to completely offset the taxable portion of their Social Security benefits. It effectively functions as a tax wipeout for middle-class seniors. However, there is a catch you must be aware of. This new $6,000 deduction is subject to an income phase-out. If you are a single filer with a modified adjusted gross income over $75,000 or a married couple over $150,000, the $6,000 bonus begins to gradually reduce by 6 cents for every dollar you are over the limit. It disappears completely if a couple makes over $250,000. But for the vast majority of everyday retirees, this provision is fully available. The tragedy is that because this law is so incredibly new, and because it requires filling out a newly created IRS form called Schedule 1A, millions of seniors who file their own taxes by hand or who use outdated software will completely miss it. They will claim their regular standard deduction and unknowingly forfeit a $6,000 or $12,000 tax shield. You must look your tax preparer in the eye this year and specifically ask them, have you applied the new OBBB enhanced deduction for seniors on my return? Do not assume they know. Do not assume the computer will do it automatically. You have to be the fierce advocate for your own money. As we bring this all together, I want you to reflect on the immense power of what you now know. We have covered the qualified charitable distribution, which allows you to satisfy your RMDs while keeping your taxable income artificially low, protecting your Social Security and Medicare premiums. We unlocked the secret of expense bunching, proving that with careful timing, you can absolutely still write off your massive out-of-pocket medical expenses and Medicare premiums. We navigated the complex but highly rewarding credit for the elderly or disabled, a dollar-for-dollar tax wipeout for lower-income seniors. We discussed the spousal IRA, proving that a working spouse can still generate massive tax deductions by contributing to a retired partner's account. And finally, we broke down the historic, brand new 2026 enhanced deduction for seniors, which when stacked with your regular and age-based standard deductions, can shield tens of thousands of dollars of your hard-earned money from the IRS entirely. Retirement is supposed to be your time to breathe, to enjoy the fruits of decades of labor, and to focus on your health and your family. It is not supposed to be a time where you live in fear of outliving your money because the government is quietly siphoning away your savings through obscure tax codes. By taking control of these 5 provisions, you are building a financial fortress around your retirement income. You are taking back control. I want to hear from you directly about this. Which one of these 5 tax breaks surprised you the most? Or which one are you absolutely going to look into claiming on your 2026 tax return? Scroll down right now and let me know your experience in the comments below, because sharing your journey might just be the exact wake-up call another retiree needs to read today to protect their own financial future.